From small investor to million-dollar mindset, are you ready? Why do individual investors keep struggling, while big investment funds win in the long run? It's not because they have more money. It's because they think differently. If you're tired of investing based on emotions, chasing rumors, and you're ready to build a strong financial future like the pros, this video might be the turning point you've been searching for. Watch till the end, because you'll gain something most investors never do: the mindset of a true winner. Part 1. Why you must think like an investment fund. Have you ever wondered why, in the same market and with the same stocks, some investors lose money over and over, while others quietly build wealth worth tens of billions? It's not because they're luckier. It's because they think differently. While individual investors often act on emotions, buying based on rumors and selling out of fear, professional investment funds operate with a clear mental framework. They don't invest with emotions. They invest with strategy. 1.1. Thinking differently makes all the difference. The difference between a professional investor and someone chasing trends isn't the size of their capital, it's how they see the market and make decisions. Retail investors often ask, "This stock is rising fast. Should I jump in? I heard there's good news coming. Buy before the hype? The market's too red. Better sell for safety?" But a fund asks, does this asset align with our long-term portfolio strategy? Where are the risks, and do we have mitigation plans? Short-term swings don't matter. What's the trend over the next 6 months? 1.2. Quick gains versus sustainable wealth. Are you investing to make a quick buck, or to build financial freedom step by step? Are you gambling, or are you operating a machine that creates value? Funds don't buy just to ride short-term waves. They buy to build assets, maximize long-term returns, and maintain discipline even when markets are volatile. That's why they're not shaken by rumors, fake rallies, or FOMO, the very traps that make retail investors lose money. 1.3. A question that can change everything. Here's a powerful question that can transform how you invest. If I were a professional investment fund, what would I do today? This one question forces you to think more strategically, to act like an institution that manages risk, capital, and long-term goals, instead of reacting emotionally in the moment. Next, we'll break down the 5 core principles every investment fund follows to stay disciplined and maximize performance. Part 2. 5 core principles of a professional investment fund. Investment funds don't operate on feelings. They operate on systems. And within those systems, there are unshakable principles. You don't need a team of analysts or a billion-dollar budget. If you apply the right mindset, you're already far ahead of the crowd. Let's break down the 5 core principles that help funds stay consistent and perform well over the long term. 2. Principle number 1. Risk always comes first. While most retail investors obsess over how much they could gain, investment funds always start with a different question. What is the risk? They never pour money in just because the upside looks good. Instead, they ask, what's the downside if we're wrong? What's the worst-case scenario? Can we exit the position quickly if things go south? Funds know Protecting capital is more important than chasing profits. 2.2 Principle number 2. Every decision must be data-driven. There's no such thing as, I feel good about this stock, or, my friend told me it's a sure bet. Investment funds analyze financial statements, real cash flow, industry position and corporate strategy, valuation relative to historical averages and competitors. They remove emotion from the equation. They act based on data, because emotion is the greatest enemy of long-term investing. 2.3 Principle number 3. Always maintain a balanced portfolio. No professional fund ever goes all in on a single stock, no matter how tempting it looks. Because one mistake can destroy everything. They build their portfolio like a well-structured building. High-growth stocks, high risk, high potential. Defensive stocks, low risk, create balance. Cash reserves, to pivot quickly when needed. Do you have a true portfolio, or just a random bunch of stocks bought on impulse? 2.4 Principle number 4. Always have a plan before acting. Funds don't buy and then figure things out. They plan first and execute second. Before they invest, they already know what price to enter and why, when to cut losses if needed, when and why to take profits, how long to hold, and what signals will trigger an exit. Without a clear plan, you're just drifting through the market like a boat without a rudder. 2.5 Principle number 5. Think long-term, but stay flexible. Investment funds always think ahead, 6 months, 1 year, even 5 years. But they're not stubborn. They're ready to adapt when the market changes. They're flexible, but never reactive. They don't trade every day, but they constantly monitor key indicators and new data. Their mindset is, stick to the strategy, but stay ready to evolve when the facts change. Backhand index pointing right in the next section, we'll dive deeper into how to build a smart, fund-like portfolio, not overloaded with stocks, but structured with strategy. Part 3. Building a fund-style portfolio. Fewer tickers, stronger strategy. An individual investor might hold 10 to 15 different stocks in their account. But for investment funds, it's a completely different game. Every stock they pick serves a clear purpose and fits into a broader strategy. They don't buy to test their luck. They don't hold just to hope it recovers. Each stock is like a piece of a well-drawn map, with a role, a goal, and a specific plan to enter and exit. 3.1. Diversification isn't always better. A common mistake among individual investors is believing that the more stocks you own, the safer you are. But in reality, when your portfolio gets too bloated, you lose track of the quality of each business. You no longer know what you're truly holding. Professional funds understand this well. They optimize, not overstuff, their portfolios. 3.2. The structure of a fund-style portfolio. A well-structured fund portfolio typically includes core holdings, large weight positions in solid companies with stable cash flows in low volatility industries, growth holdings, stocks with high upside potential over the next 6 to 18 months, though they carry higher risk, opportunistic picks, timely buys based on attractive valuations or specific catalysts. Cash reserve. Always keeping some cash on hand to pivot quickly when the market shifts. With this approach, every component is assigned a role and actively managed. Nothing is held just because. 3.3. A plan for every single stock. Investment funds create clear plans for each stock they buy. But what's the investment thesis? What data supports it? Time horizon? Is this a 3-month, 6-month, or multi-year position? Exit strategy? If the valuation reaches the target or the business outlook changes, they exit without hesitation. Are you doing the same for each stock you hold? Or are you just buying and hoping the market will bring you back to shore? 3.4. Lean doesn't mean risky. A portfolio of just 5 to 7 well-understood, strategically selected stocks is often safer than a 15-stock mix bought because someone hyped it up. Funds don't aim for quantity. They focus on quality and performance. Investing isn't about collecting bricks. It's about building a strong, lasting house. Backhand index pointing right in the next part, we'll learn how to read the market and manage a portfolio like a pro, knowing when to go aggressive, when to play defense, and when to stay on the sidelines. Part 4. Reading the market like a fund. Go aggressive when others fear. Defend when everyone's greedy. Investing is not about who picks the best stocks. It's about knowing when to move and when to stay still. Successful funds aren't great because they always pick the right stocks. They win because they act at the right time. 4.1. Funds don't trade constantly, they wait. While retail investors constantly ask, should I sell now? What should I buy next? What if I miss the wave? Funds can stay quiet for a whole month or even an entire quarter just to watch and prepare. They understand this truth. Markets move in cycles. And not every moment is one for action. 4.2. The 3 strategic stances of a fund. Like a seasoned fighter, a fund knows how to shift stances depending on the situation. Offensive mode. When valuations are low, liquidity is improving, and the crowd is still cautious, this is when they go in strong. Defensive mode. When the market is surging, good news is everywhere, and optimism peaks, they start reducing exposure and raising cash. Neutral mode. When the market shows no clear direction, they hold a balanced position and avoid rash decisions. The question is, which stance are you in right now? And can you shift gears like a fund? 4.3. No need to catch tops and bottoms. Just read the rhythm right. Funds don't try to catch the exact bottom. They don't panic to sell at the very top either. They act based on market data and liquidity flow, not emotion. They observe trading volume, foreign investor activity, sector rotation and index behavior, bond yields and interest rate trends. All to answer one key question. What is the market trying to tell me right now? 4.4. Let reason lead. Let emotion listen. An individual investor might buy or sell out of fear, but a fund simply cannot afford to act that way. They operate by principles. They follow a decision-making process. They listen to the market, but they are not driven by it. They know doing nothing is sometimes the smartest move. Backhand index pointing right in part 5, we'll get to the most crucial part: how to build your own fund-style investment thinking system so you never feel lost in a market full of choices. Part 5. Building your own fund-style investment thinking system. You don't need billions to think like a fund. You only need one thing: a systematic mindset. Successful funds thrive because they operate with clear principles, clear processes, and actions free from emotional impulse. The good news is, you can build that system too, starting today. 5.1. Set your own screening standards. Before picking any stock, ask yourself, has this company shown consistent revenue growth over the past 3 years? Is the leadership trustworthy? Are the profits coming from its core business? Is the stock liquid enough to exit easily? Don't place a single order unless the stock meets your full checklist. That's how funds build their portfolios, and you should too. 5.2. Have a clear investment roadmap. Instead of investing on a whim, break your plan into steps. Stage 1. Research, study the company carefully, observe the market. Stage 2. Probe, start with a small position, test the market's reaction. Stage 3. Go big, when signals align and the market supports your thesis. Stage 4. Protect profits, set disciplined stop-loss or take-profit levels. This is how funds deploy billions strategically. You can apply the same logic on a smaller scale. 5.3. An investment journal, your secret weapon for growth. Every fund has a reporting team that reviews decisions. Because they know, failing to learn from the past means paying for it in the future. You should keep a personal investment journal. Why did you buy that stock? What did you expect at the time? What was the outcome? How did you feel when making the decision? Write it down. Review it. Improve every week. Just 3 months later, you'll already see a new version of yourself. 5.4. Patience is a competitive advantage. Remember this. The market is a machine that transfers money from the impatient to the patient. Funds can wait 1 to 2 years for a company to prove its worth. They don't chase quick wins. They aim for sustainable returns. The more patient you are with your system, the better your odds of winning. You don't have to be smarter, just more persistent than the rest. In the final chapter, Part 6, you'll receive one last spark. The mindset of a champion. Why thinking like a fund doesn't just help you invest better, but live better too. Part 6. Think like a fund, live like a champion. You've walked with me through 5 chapters. And now you've seen it. Investment funds don't win by luck. They win through systematic thinking. They don't chase market waves. They pave their own path. They don't invest with emotion, but with discipline, strategy, and patience. And the amazing truth is, you don't need millions to do the same. You just need to change one thing: your mindset. 6.1. Stop being a gambling chip. Don't let the market treat you like a small fish in the ocean of speculation. You have the power to choose, the ability to analyze, and a value of your own. Invest with the intelligence, discipline, and willpower of someone who owns the game. 6.2. Invest better, live better. When you learn to think like a fund, you no longer chase rumors. You know how to wait for the right moment. You know when to stop. You're not just making money, you're building a solid financial future. That's how successful people run their lives, not just with money, but with how they decide, persist, and rise above emotions. 6.3. Start today. You don't need to wait for the perfect moment. You just need to begin. Define 3 personal investment criteria. Record your decisions. Ask yourself, would a professional fund do what I'm doing right now? Repeat this long enough, and you won't be just a retail investor. You'll become someone else. A mature investor with identity and inner strength. 6.4. Shift your mindset, change your finances, transform your life. Remember, money doesn't just fall into your lap. It flows to those who think like owners, not like gamblers. If this video awakens something in you, share it with others still drifting in the ocean of the market. Like, subscribe, and leave a comment. I choose to think like a fund. Let that be your first commitment on the path to investor maturity. See you in the next video of the series, Sharp Financial Thinking, where we don't just talk about money, we talk about conquering ourselves,